All right, so we are recording, and I'm going to go through some things. I don't have any PowerPoints, but I am going to make some notes, and hopefully this will be clear, and then we'll go into a Q&A, if you will. You can ask some questions, and I'll try to explain and make things clear if possible. So first, I want to know, just so that I understand, how many of you guys trade a 112, whether it's on SPX or SPY, or maybe you're using ES or MES options? There is a chat, or I think that you're able to unmute yourself if you wanted to say it out loud. All right, so we got some people. All right, I know Gabe trades. Got Alex, Eddie. So this is one of those trades that has become quite popular in the last year or so. Everyone and their dog trades 112. Now, is there a one way, right? The right way to trade 112? In my opinion, there isn't. Right, this trade is extremely flexible. You can set it up any way you want for as much credit or debit as you would like, depending on your market outlook. And we're going to compare real quick a 112 to the defined risk bear trap that we're going to look to set up. So a 112. Let me get rid of what's on my screen here. I guess the first step, what we want to do is to understand our days until expiration, right? Before we look at the strikes and credits and debits and all that stuff, you want to understand, how long you want to be in the trade. Now, we did some back testing and try different time frames. 112 works on any time frame, whether it's 21 days, 45 days, 60 days, 95, 120. The only difference I will say is that the more days you have until expiration, meaning the farther out in time you go, the further out of the money your naked options are going to be, right? Because you have more premium available further out of the money with more time until expiration. And that's the positive, right? You get more distance to your downside break even. But the negative, right? There's always the positive and the negative. So the positive is you can go further out of the money with your naked options. And that's the positive. And the negative is that you're going to have to stay in the trade longer, which means that you have a higher probability of something drastic happening, right? If you were in the trade for 30 days versus 90 days, in a 90-day trade, you have that much more time to potentially catch a black swan, if you will. So to compensate for that risk of potentially staying in the trade longer and potentially running into trouble, you get compensated by being able to place your naked options further out of the money. When it comes to days until expiration, for me, at least, I don't like to trade 21 DTEs as much as I would like to trade somewhere around 45 to maybe 60 days. And that's my personal preference. You could be different. That's what, works better for me. 21 DTE compared to a 60 DTE trade, even though they're set up in a similar way, a 21 DTE trade is going to be a lot closer to at the money. There's also going to be a lot more sensitivity to price changes day to day. It may not sound like a big deal right now because the market isn't really moving a whole lot. But if you set up a 21 DTE or a shorter term DTE trade, let's say when the VIX was at 21 rather than 13, you would understand that 21 DTEs compared to a 45 or a 60 DTE carry a lot more risk, only because you have less time, which means that you will get the result of the trade a lot quicker. And that's the positive. You don't have to hold risk for that long. And that's the positive. The negative is that you will have drastic P&L swings if the market starts to go up and down from day to day. So as far as DTEs go, I look for somewhere between 45 and 60. So I hope you guys can see my screen here. 44 DTE is August 11th expiration. And the way I set up my 112s, right, I look for a 50-point wide put debit spread. And I look for a put debit spread that is 50 points wide and is for a debit of around $10. Right now, you can say, well, why $10? This is a number that I've tested different variations and they all work well, but this is something that works for me because, you can set up a 50-point wide put debit spread instead of $10 debit. Say you want to pay only $3 debit. Well, this put debit spread is going to be so far out of the money that in a uptrending market, there's a very low probability that the price will ever get to that put debit spread, meaning you will rarely catch price inside of the bear trap. And while you will have a pretty profitable trade over a long period of time, majority of your profits are going to be from the initial net credit that you're going to collect. So I found even in an uprising market, a 50-point wide put debit spread for a $10 debit, I have maybe 20% probability of price being inside of that put debit spread. So we can look, just to give you a visual here, let's look at what in the 11th of August expiration cycle at 43.30, right? If I buy one 43.30 put, and then I sell a 42.80 put, right? So this is going to put me in a 50-point wide put debit spread. And this put debit spread is trading for about $11.30. So it's more than what I was initially looking for. I can change the strike. So from 43.30, we can go down to maybe 43.10, right? So I'm going to move things down 20 points. So I'm going to buy the 43.10. And I'm going to sell a 42.60. Okay. And this 50-point wide put debit spread is going for $9.90 or $9.90. Okay, so that would be my target as far as the put debit spread part of the trade. Right, 112 is a one put debit spread, which is financed by a sale of 2 out of the money puts naked. So I'm spending $9.90 or $10 where this put debit spread is trading right now. And we can look at my long option is at delta of 34 or 35, which means that there is a implied probability of profit for this option only about 35%, which means that there's a 65% probability that this option 43.10, which is the long leg of my put debit spread, is going to expire out of the money. Let me say this again. There is a 65% probability that 43.10 is going to expire out of the money. which means that there's about a 35% probability that the price is going to be at 43.10 or lower, right? So if we were to just think about this put debit spread by itself, there's about a 35% probability that the price is going to end up in the trap. In an uprising market, the actual, so if we look at, implied probability of something happening versus the actual results, and, we can do a back test just to kind of get an idea if the probabilities are going to play out the way they're setting up. I think that the actual number is actually lower. I think you get maybe 20, maybe 2 out of 10 times in a steady market, not in a down market like we saw last year, but in a sideways to uptrending market, there's maybe a 20% probability that the price is going to end up underneath the long or lower than the long leg of this put debit spread. So you can say, do I have to do a 50-point wide spread? No, you don't. You can do a 10-point wide spread. You can do a 20-point wide spread. You can do a 100-point wide spread, right? It really doesn't make a difference. You do what works best for you. And do I have to do a 50-point wide for 10? No, you can do a 50-point wide for $25 debit, right? Which is going to be a lot closer at the money, which means you're paying more for this debit spread. But by being able to place this put spread closer to at the money, you are also increasing odds of price being inside the trap at expiration, right? So you're paying more, which is the negative, but the positive is you have a higher probability of price being inside of the bear trap. So if I'm paying $10 debit for my put debit spread, now I know that I need to go out and look for an option that is trading for around $10. All right, here are my mid prices. So we scroll lower, we have 40.30 that's trading for about $10.45. We have a 40.25 that's trading for about $10.20. I would probably look at 10.25 before I look at 10.30, not only because it's 5 points lower, but it's also because it's a quarter price, meaning we have round numbers such as 4,000, 4,100. Then we have half numbers, which is 40.50, 39.50, and then we have quarters, 40.25, 40.75. So around these quarters, halves, and whole numbers is where you will likely to find a little bit more liquidity. This is where institutions like to trade. And you will also find a little bit more of an open interest. So getting a fill, if I had to guess, if you are buying or selling an option and you're looking at 40.30 or 40.25, 40.25 will probably get you in a little bit faster, or maybe bid-ask spread is going to be a little bit tighter. Or if you put your order out there, there might be someone on the other end of that trade, because like I said, institutional participants trade around round numbers, half numbers, and quarter numbers. So if we sell 2 of these 40.25s, right, I'm paying $10 for the put debit spread, and I'm selling 2 of the 40.25. So with the first put that I'm selling, I'm recovering the cost of my put debit spread. And by selling another put naked, right, I have 2 naked puts for every 1 put debit spread. This is going to give me a net credit of about $10.60. And this is what the risk profile is going to look like. Right, so we have a net credit that we are taking in Now, if the price is going to trade higher, right, and we're talking about an uptrending market, if the price trades higher, the most we can make is the credit that we take up front, which is $10.60, right? This is a delta positive trade, and we have positive theta, which means that we need the price to go up or at least not go down aggressively. And as the time passes, the value of all options that are part of this trade is going to decay. We are selling more premium than we are buying, which means that our short options are decaying at a faster rate than our long options. Therefore, we get net positive effect from time passage. And we're also short volatility, which is kind of a risk, but not really, right? At first, earlier in the trade, if volatility spikes right away, sure, this trade is not going to be pretty, but then assuming that volatility is going to mean revert at some point in the future, as long as we don't blow past, our downside break even where we really run into a pretty nasty P&L, at some point, volatility is going to revert and the trade is going to autocorrect. Right. So the biggest risks here are delta, that's number one, and volatility, which is not as significant as delta, but it still is a risk nonetheless. As you can see that on the downside here, right, if the market was to move down, say 10%, sure, the put debit spread is going to kick in and it's going to be profitable. But we have two naked puts that are short, they're going to increase in value, right? If right now they're going for $10.20, and these are, $8 puts. If we were to drop, say, 10% down to about $39.50, right, that's 400 points. If we are going to lose about $8 for every 1 point S&P goes down, and we have two of these options, right, you can do the math. So we are holding net, say, negative about 16 delta. And if you multiply 16 by 400, this is how much you are expecting to lose if the market was to dump about 10% in a very short period of time. The theta is only $90 a day, so it's not going to help us a lot. And volatility, right, we're short about, for every one lot, we're short about 400 Vega points, and that means that for every 1 point volatility goes up, we should expect to lose another $400. So if the market goes down 10% and volatility goes, up maybe 10 points, meaning the VIX goes from 13 to 23, you should expect to lose another $4,000 on top of that. Right, so that's a lot of risk, and that's why a lot of people choose not to put on trades in SPX. This is it's a big contract. It's a $4,375 instrument, and selling naked options on SPX is not for everyone. So for those that can't or choose not to sell SPX options naked, we can look at a slight variation or a different setup where your risk is defined. And I'm going to lay out some very basic guideline. This is what I use. You can take it and you can change it in any way, shape, or form that works for you, and that's totally fine. There is no wrong way of doing it. Right? The wrong way of doing it is not doing it or not trying to do something with it. Just because something works for me doesn't mean it may work for you, but the idea is going to be very similar, and you may be placing your strikes further or closer to at the money. And maybe you're changing the width of the spreads. It all works fine. So let me just go back and get rid of these options here. And before we go further, so if you guys have any questions so far on what we talked about here, and we just basically talked about the basic 1-1-2 setup that I use. If you do have a question, feel free. You can unmute yourself if you want to, or you can put it in the chat. I will monitor, and if we're all clear, then we can move along. All right, I guess we are going to move on, but if you do have a question at some point, you will have an opportunity to ask. So a 1-1-2 variation, which would be a defined risk, I would just call it a bear trap, right? For the trades that I take with an unlimited downside risk, those are 1-1-2 bear traps. A defined risk bear trap is just a bear trap. If you guys have any other clever names you want to come up with, feel free to share. And if it sticks, then we'll use that going forward. If not, a bear trap, I guess, works just fine. So the first thing that I do when I look for a defined risk bear trap is, again, I look at the DTE, right? Days until expiration. And it's same as it would be with an undefined risk bear trap or a 1-1-2. The closer you are to expiration, right, the less days you have in the trade, the more riskier or the more sensitive to price swings the trade is going to be. So if you don't want to monitor every single day, if you don't want to think about it at night, stay away from short-term expirations, right? If you put on trades that are 21 or 28 days or 14 days or 7 days until expiration, and those make you nervous, it's probably not the right expiration cycle to use, because you should only try the same trade once with a lot more time until expiration, and you will notice a difference that trades with more time until expiration will make you less nervous, and they're going to be a lot slower moving, right? So you'll get paid a lot slower, but you're not going to have as much stress as you would with trades that have very short duration and you are to get paid relatively fast. So there's a trade-off. You get paid fast with more stress. You get paid slow with less stress. What works best for you, only you know. So no one here will ever tell you that you should do A or B. You are going to decide what works best for you. For me, these bear traps, so I've been doing these bear traps with somewhere around 45 days, could be 51 days. Again, we can look at the same 44 days until expiration, which is August 11th. We can look at August 18th at 51 days. For me, I also have a number of different trades that are spread out all across different expiration cycles. One thing I always try to avoid is having strikes overlap. So like if I have trades that are in August 18th expiration with 51 days until expiration, I would try to avoid, unless I'm doing something closer to at the money or way farther out of the money. I want to always be aware where my existing trades are so that I don't end up stepping on some of the options that I already have open, because then that's going to just make things really weird and kind of hard to keep track of, right? You have trades overlapping. We don't want to do that. So for example, here I have a trade in 18 AUG, AM and PM settled. So in this situation, I would go with a 44 days until expiration, knowing that the trade is going to be a little bit more sensitive to price change, and that's fine. But I wouldn't want to put on the trade where I already have positions and potentially have the options cross and make my position super weird. So DTE is the first thing I look at, right? Once we find the DTE that we want to go with, next thing we want to do is we want to look at a put debit spread, right? So the difference between a 112 bear trap and a defined risk bear trap is that 112. Hold on. Gabe is asking, are you showing risk profile right now? Are you guys not seeing my screen? Oh yeah, no profile. So I haven't placed any options. So maybe you can see that now. Okay, so screen is okay. Right. I didn't, there was no risk profile because I haven't chosen any options yet. So the difference between a 112 bear trap and a defined risk bear trap is that 112 is exactly that. We have 1-1, which is, one long, one short option. That's the put debit spread. And then 2 is the -2, which is the 2 naked puts. Defined risk bear trap is a 1-1-2-2, right? So that last 2 is what defines the risk. And the way I'm going to set up my put debit spread, one of two ways, right? We can, number one, look at what is market currently pricing in. We can look at the price of an at-the-money straddle, or we can just look at the price of an at-the-money put, right? At-the-money put is trading for about $60. So if I wanted to place a put debit spread where if we were to move one expected move lower from today's price, we are going to hit our long leg of the put debit spread. I'm going to say this again. Right now, right, the market's at 43.75, and we know that the market is currently pricing in, right, to the downside about 60 points. So I want to place my long leg of my put debit spread right where we would have to go -1 expected move and potentially hit the long leg of our put debit spread. And if we move a little bit more than what the market is pricing in, right? Because on the downside, the market tends to go further what the market was pricing in before we take the trade. Meaning that if the market right now is pricing in, let's say, for a move from 43.75 down to about maybe 43.10, if we are going to move lower, we're probably going to move more than what the market is currently pricing in. Because what's going to happen is, as we move lower, right, implied volatility is going to start to rise. Those that have been selling premium in the last couple of months are going to probably be forced to hedge, which means they're going to have to go out and buy a bunch of protection. In turn, the dealers or the market makers will have to hedge off their positions by shorting futures and so on and so forth. So we tend to move to the downside a lot more than what the market normally prices in. So my thinking is that if 43.75 is trading for about $60, let's see what a 50-point wide put debit spread, 60 points out of the money would look like. So I'm going to go out from 43.75 down to 60 points would be 43.15. As we can see, there is no 43.15 right now. Maybe there will be one later on. So I would go to the next available, which is 43.10. And I place my long leg at 43.10. And then I go down 50 points. 42.60 is my short leg. And this is what a 50-point wide put debit spread looks like. It is currently going for $9.80. So that's step one. And just like I said with the 112, does it have to be 50 points wide? No. Does it have to be 50 points wide for 10? No. Right? You can do a 50-point wide for $5, which means that the same put debit spread, but for less of a debit, right? A cheaper or lower price debit spread is going to be further out of the money. There are two sides, the positive and the negative. What's the positive? The positive is that you're only spending $5 instead of 10, so you're paying less, but your put spread is further out of the money, which means you have less of a probability of price ever reaching or expiring inside or in the trap. So the closer we move this put debit spread to at the money, the more we have to pay for it, but we're also increasing probability of price going inside of the trap and expiring for a full trap profit, if you will. Right, so I think this is pretty similar to what we were just looking at as far as 112 put debit spread. And Chuck is asking, where did I find expected move? We can take the price of an at the money straddle, combine the price of an at the money put and at the money call. So right now, 43.75 was a $60 put. I would assume that 43.75 call is somewhere also around. So this is interesting. So 43.75 call is at 81.35, and 43.75 puts are $60. So the calls are juicier. There's more premium in the calls, with the market being at 43.75. What I would do is I would only take the price of the put and try to go out of the money by as much as what the price of the put is. So if that 43.75 put is at $60, I would go $60 away from at the money put. So 43.75 minus 60 is 43.15. There is no 43.15 strike, so I would move to 43.10. And that's where I would put in. No matter how you slice it, that long leg of the put debit spread is going to be around 35 delta. So you can just look at the delta, or you can, go count the strikes, but it's always going to work out about the same. Meaning that with the VIX at, I don't know, what is it, at 12 yet? I don't think so. VIX is at 13.5. So with the VIX at 13.5, the 35 delta put is at 43.10. 43.10 from 43.75. Right, so we go about 60 points out of the money from 43.75. That's about 1.4% out of the money. And if you look at something similar, 45 DTE, when the VIX is at, let's say, 25, right? That same 35 delta put is going to be further out of the money. So the more volatility there is, the more premium there is in the price of options, the further away we get to play. But the trade setup is still going to be the same. That same 50-point wide put debit spread with the long leg at 35 delta is going to be somewhere around $10. It's just that the entire put spread is going to be, instead of 1.4% out of the money, with the VIX at 25, this is probably going to be like 7% out of the money or something like that, right? I'm just making numbers up, but I hope you get the idea that higher volatility allows us to go further out of the money. But it doesn't change that what I'm looking for is a 50-point wide spread, right? Put debit spread, 50 points wide for about $10. All right, so 50-point wide for $10 debit. We found that. And now with a 112, I would just go out and look for an option or a put option that is trading for about $10, and I would sell 2 of those. Instead of doing that, I'm going to look for a 50-point wide put credit spread that is trading for about $5. And I'm going to sell 2 of these put credit spreads, right? If I'm selling 2 put credit spreads, $5 each, I'm taking in $10 credit, which is going to cover the cost of the put debit spread. I'm spending $10 on my put debit spread, and then I'm selling 2 put credit spreads, $5 each, collecting $10. So I collected 10, I spent 10, net, I should be close to break even or flat on as far as entry goes. Not paying anything, not collecting anything. I have a 50-point wide put debit spread, and then I'll have 2 50-point wide put credit spreads. Now we can look at, I've modeled this enough times to believe that that 50-point wide put credit spread for $5 is going to be somewhere around delta 15. So delta 15 right now is at 41.60. If I sell 2 puts at 41.60 and then I go out 50 points, right, and I buy 2 puts at 41.10, we actually don't have enough credit to cover all of what we would spend on the put debit spread, because this would show a net debit. We can, however, and I like this setup much better, and we'll come back to it. So in order to collect a little bit more credit, in order to cover the cost of the put debit spread, we would have to move up maybe 20 points higher, sell 2 of the 41.80, and then buy 2 of the 41.30s. And that would give us still a net debit of about 90 cents. So these 2 put credit spreads will be almost enough to cover the cost of this 1 put debit spread. Does that make sense? And if we wanted to not pay any debit, we would have to move up maybe another 20 points. So let's see if we go to 4,200 and sell 2 of the 4,200s and then buy 2 of the 41.50s. And now we have a net credit of about 15 cents. So now we buy a 1 50-point wide put debit spread for $10, and then we sell 2 put credit spreads for just over $10 in total, right? They're like $5.15. We get a net credit of about 20 cents. Okay, here we are. I don't know if you're going to see this, but this is what the order. Right, so we collect a slight net credit. We have 2 put credit spreads and 1 put debit spread. Both are 50 points wide. And we can look at the Greeks here real quick, right? We have a very small positive delta. Remember, 112 was also a positive delta trade. We have positive theta. Remember, 112 was also a positive theta trade. And we have negative vega, just like 112 did, which means that if implied volatility is going to rise, this is going to work against us, just like in a 112. The only difference here is that the numbers are a lot lower, right? Theta is only +9. And if you remember 112, we just talked about, vega was -400. This one is only -60 or 62. So we are a lot less sensitive to changes in price and in changes in volatility, right? That's the positive. We're not as sensitive to price changes and a potential increase in implied volatility. That's the positive. And the negative is that our theta, or what we make for every 1 day that passes by, is only +9, whereas 112, I don't remember what that number was, but it was definitely a lot higher than +10, right? So we get paid less per day, assuming everything else remains the same. We get paid less, which is negative. The positive is we won't see crazy P&L swings if the market starts to move up or down on a day-to-day basis. Now, this is a general idea. This isn't, a hard and fast, written in stone rule. This is the only way. It's not. You can set this up any way you like. If you like 50-point wide spreads, do 50-point wide spreads. If you want to do 100-point wide spreads, do that. If you like to use 10-point wide spreads, it doesn't make a difference. We need to understand what the risk is, right? Remember, we looked at the 112. If the market was to dump, right, 10%, we were looking at something like a $26,000 loss. Whereas in this setup, if the market goes down 10%, our losses are only about $3,000. It's still a lot of money, but it's not as much compared to holding a 112. Right, so we have a lot less at risk, if you will. Less risk, which is positive. Less reward, that's the negative. We do make less if the price is in the trap. And, right, that's the negative. We make less in the trap, but we also don't take as much risk. And that if you put this trade on and do nothing else, just completely forget about it, which you shouldn't do. But if you do, right, the most you could possibly lose here is $5,000. Whereas in 112, if the market goes against you and it continues to go and continues to go, your losses are going to blow out exponentially. And I mean, obviously the market can't, in theory, market can't go to zero, but, so the downside losses are not unlimited. They're limited to your short strike, which is in this case 4,200. So you could lose a lot of money. Let's see. So, all right. So we have a question from Jose, just connected question, SPX versus ES. You can't compare SPX to ES only because SPX options and ES options, your buying power is going to be way different. And Jose is saying that SPX was taking 4 to 6x more buying power. It's true because ES options, they use span margin. But if you were to compare, and I don't trade options on futures, so I may be wrong here, but if you compare, for example, if you compare SPX portfolio margin to ES, those are probably a little bit more apples to apples comparison, but comparing SPX to ES is comparing apples to oranges. So yes, if you are concerned with buying power usage, you're probably better off with ES options. However, you should do keep in mind that ES options are only half the size, or their multiplier is 50 instead of 100. So you would have to do twice as many number of contracts to collect the same dollars in the trade, which means that doing 2x number of contracts, you potentially multiplying your commission cost by 2. Which one is better? There is no better, right? Which one works for you? That's the better one. Right, you have to try one, you could try the other. If you have never traded SPX options and you have the ability to maybe do one contract, then I would, doesn't matter what the size of your portfolio is, start with one, right? Get a feel for the trade, see how it works, understand how it moves, why it moves, when it does, and what to expect when it does move. And then once you get the hang of it, you could move on to increasing your size, or you can just, maybe run one SPX and 2 ES 112s side by side, just to, get an idea which one works better for you. And based on the outcome in your personal experience, those are determining factors, which one is going to be better for you. Josh is saying, could XSP be an alternative that doesn't risk such large max loss, or would the profit potential is not? So XSP is just 1/10 of it's kind of like if you're comparing SPX and SPY, right? XSP is just 1/10. So your max loss isn't as great, but your max potential reward is proportionally cut into 10, or it's just going to be 1/10. So here, if you're looking at this trade here, for example, you have to put this defined risk 112 bear trap, you would have to put up $5,000 with your broker, right? Your buying power will be reduced by $5,000. If you did the same thing with XSP, you will be putting up $500, but your max potential reward inside the trap, assuming that you catch the price at expiration somewhere between 4,200 and 4,260, right? With SPX options, your max potential reward inside the trap is $5,000. If you were using XSP options, your max potential reward is $500 as well. So here with SPX options, you are potentially risking $5,000 to make $5,000. And with XSP options, you will be risking $500 to make $500. So yeah, using XSP options also is an alternative, right? It cuts your size in 10. If you don't want to put up $5,000, or if let's say you wanted to do only, I don't know, $1,000 worth of max risk, right? Whereas this one lot requires 5,000, and you wanted to, you don't want to put up 5,000, or you wanted to do just 1,000. So go into XSP, which will require only $500 per one lot. If you do two, right, there's your max risk of 1,000 instead. So using XSP will allow you to take risk in absolute terms down, but you will have to increase the number of contracts. All right, so the setup here is one 50-point wide put debit spread financed by a sale of two 50-point wide put credit spreads that are slightly further out of the money. And the way I like to set up this trade, as you can see here, we start off with net positive delta. And you could change this, right? Is this the only way to set this trade up? The answer is no, right? Think about what's your near-term outlook for the market, right? You can look at the price chart. So we are in an uptrend, at least since about October of last year. And you can see that because the market is making a series of higher highs, right? Every high, except for in April, we kind of ran up to a previous high. We paused a little bit, and then we're resuming that trend. So we have to assume the trend is still up, and we're making a series of higher lows, right? October lows were around 3,600. December lows were around 3,800. March low was around 3,850, and so on. So the trend is up. And if you think that the market's going to continue to trend higher, then you can set up a trade that has no risk to the upside and has a net positive delta. Or if you said, well, you know what, we've been trending since October. I don't know how much gas is left in the tank. I think we may go sideways for the rest of the summer, or at least until August 11th. I'm not as bullish. I think we're going to see a little bit more of back and forth. Okay. What you can do, instead of putting your put debit spread at 43.10, 42.60, you can put it a little bit closer at the money, which means that this put debit spread is not going to cost $10. It may cost $12, right? If you're collecting, if you're paying $12 for this debit spread and you're collecting $10 for two of these put credit spreads, you will have a net debit of, right, $2. You spend 12 and you collect 10, you're net minus 2. You have a $2 debit to put the trade on. And we can see what that would look like. So instead of using 43.10, let's go and see maybe 43.20. So we'll buy a 43.20. And then we'll sell a 42.70. That's not enough. We can go up another 10 points. Maybe we go 43.30, 42.80. All right, so now we moved the debit spread a little bit closer to at the money, and that has created a net debit in this trade of about $1.20. So we collect $10 for the two put credit spreads, and then we're paying about $11.20 for the put debit spread, which is creating a net debit. We're not entering for a credit, we're entering for a debit. We're paying money, which means that if the price is going to trend higher, we have risk, and that risk on the upside is the debit that we're paying to put this trade on. We also have risk to the downside, right? If the market goes down, but it goes way down, right? If it goes below our downside break even here, we have risk. And that risk, remember, in the previous example where we didn't have any risk in this trade setup, we were risking 5,000 to the downside, and we had no upside risk. And now, since we are paying a small debit, we're introducing upside risk, which is $1.20. Our downside risk is the $5,000 plus the debit that we're paying, or $5,125. This simply means that, let's assume several scenarios, right? The best case scenario for this trade is the price is inside the trap at expiration. Okay, so if we're inside the trap, say we're at 42.50. This is the best case scenario. I'm going to give you the good news first. 42.50 at expiration in 44 days. What happens here? We have a 50-point wide put debit spread, which is worth what? 50 points. It's worth $5,000. We have the two of the put credit spreads that are going to expire worthless. They're worth nothing. So we have a $5,000 profit minus the $120 debit, right? So our max potential return inside the trap is $5,000 minus $120. $4,880. That's the best case scenario. If we're somewhere inside or between the 42.80 and 43.30, we just have to figure out what the long option is worth at expiration minus $120 debit, and that's what this trade is worth at expiration. Same thing on the other side. If we're somewhere between 4,200 and 41.50, or you can say the downside break even. If we're somewhere here between 41.75 and 4,200, we would have to take, right? So this debit spread is worth 5,000, and we would have to count and figure out how much is our 4,200 put is in the money buy, and subtract the difference between two, right? We'll have a loss on this side here, but we'll have a profit on this side here. We have to figure out the difference minus the debit, and that's what our P&L is. But nonetheless, the trade is going to be profitable inside the trap. On the outside the trap, if the market goes higher from here and we do nothing else, the most we can lose is the initial debit, $120. Right, that's the upside risk. Not great. And this is one of the main differences between the 112 bear trap, where we put the trade on for a net credit, which means that if the price is going to trend higher from the moment we put this trade on and we do nothing else, we will get to keep the initial credit. It could be a small credit, it could be a large credit. With the 112 that we looked at earlier today, that initial credit was about $10 or so. With the first example of this defined risk bear trap, we had a small net credit, about 20 cents or so. So that was our max potential reward. Now we moved our put debit spread a little bit closer to at the money, and we ended up with a slight net debit for this trade. And that's the risk, the net debit that we're paying to put this trade on. So if S&P 500 is above our long leg, which is at 43.30, at expiration, we're at $120. Small risk relative, right? You have to put up $5,120 for this trade. And if the market just runs away from us and we don't make any adjustments, worst case, we're out $120. On the downside, if let's say the market dumps 10% between now and expiration and we do nothing to defend this position, which is not our plan to, right? We do not plan on doing nothing. If the market goes down by expiration, we will have made a $5,000 profit from our put debit spread minus $120 debit, right? 48.80. So we'll make almost $5,000 on the put debit spread, but we will lose 50 points times 2, which is $10,000 from the put credit spread. So minus 10 here plus 5 here. That gives us a net loss of 5,000, right? We lose 10,000 here. We make 5,000 here. That's minus 5. Add the $120 debit. We will have lost $5,120. If S&P is below 41.50 at expiration or in 44 days. So those are 3 potential scenarios, right? We're either below our lower long option, which is at 41.50. We're inside of our break evens or inside the bear trap somewhere. This is the best case. And another potential loss, which is not as great as it would be on the downside if the market runs higher and we don't do anything else, we will lose our initial debit, which is $120 or so. So now let's somebody asked me earlier today about doing these kind of trades, and another potential another way to set this up, right? Instead of selling 2 of the 50-point wide put credit spreads here, can you just do 1 100-point wide put credit spread? And the answer is yes, right? 2 50-point wide put credit spreads have a total risk of $10,000, right? 50 points, which is 50 times 100, right? S&P 500 options have a multiplier of 100. 50 times 100 is 5,000. We have 2 of these spreads here, so total risk is 10,000. Doing 1 100-point wide put credit spread, right? 100 points times 100 multiplier is 10,000. So the risk is the same. We just may not be getting as much credit for 1 100-point wide put credit spread versus 2 50-point wide put credit spreads. So we can just look at this same exact setup here that's going for $1.20 or $1.30 debit, and that's using 2 of the 50-point wide put credit spreads. If we were to do 1 100-point wide, right? So we're selling 4,200 and we're buying 4,100, right? Instead of doing 2 50-point wides here, we're doing 1 100-point wide and our debit goes from $1.20 to $2.50 or $2.60. So doing one 100-point wide credit spread versus two 50-point wide put credit spreads, you don't get as much credit for the 100-point wide credit spread. So your net debit is going to be a little bit higher, and that is also going to change the Greeks a little bit. You will have a little bit more negative delta. You will have a slightly higher theta, and Vega is about the same. Right, so now think to yourself, right, what's your outlook? If you're bullish, then you want to enter this trade for as close to even as possible. You don't want to pay a debit. If you don't pay a debit and actually end up collecting a credit, you will end up with a net positive delta to start. And that's going to align with your bullish outlook. If you're neutral, you want to enter this trade for as close to delta neutral as possible. Maybe you will pay a small debit. Maybe you won't pay a debit at all, but you want to look at your total deltas. It's got to be close to zero. If you are not as neutral or bullish, if you're bearish, if you think something's going to happen over the next month or so, you want to start this trade off a little bit more bearish, which means you can either increase the width of your put debit spread or move this put debit spread closer to at the money. In any case, this is going to increase your net negative delta, which should align with your bearish market outlook in the near term. Right, so strike selection and the width of the strikes and how far you're going to place these spreads, right, the debit spreads and the credit spreads out of the money is all going to dictate, or it should all align with your market outlook. So if you're bullish, you need to set up this trade in a way that you will start off with net positive delta, and you probably are going to end up with a net credit to enter. If you're neutral, you're probably going to spend a little bit of a debit, and you're going to start off with a very little negative delta. If you're bearish, you will start off with a larger debit, and you will end up paying a little bit higher of a debit. Which one is better? There is no better. It's all about what you think your market outlook is for the time being, right? This trade has, in this example, 44 days. So in this time frame, where do you think the market is going? And based on your outlook, you set up the trade that is going to more or less align with your directional bias in the marketplace. I am not a fan of doing these 100-point wides. I mean, they do work, and you'll save a little bit on commissions. But I think that it is a little bit easier to get in with two 50-point wides. I may be wrong, but that's just my experience. If I was to sell, or maybe if I want to start off with a little bit more negative delta to begin with. So this put debit spread is going for $11.40. Maybe I move my put credit spreads a little bit further out of the money, collecting a little bit less of a credit. So if I'm collecting less credit and I'm paying more of a debit, right, this trade is going to start off for a net debit, which means that I'm going to start off with more negative delta. And this is what this trade would look like. So if I'm selling 41.70 and I'm buying 41.20, two of these put credit spreads, if I'm selling two of the 41.70, 41.20s, I will end up spending $2.85. You can see my delta is negative, theta is positive, and now just like in the last example, we have three potential outcomes. We have risk if the price is at 43.28 or higher at expiration. Our potential risk or potential loss here is the debit that we're paying, or $2.70 or $2.80. If the price is below our break even, which is at about 41.46 at expiration, we have a loss. And if the price is under the lower long option, which is at 41.20, if SPX is below 41.20 at expiration, we're out $5,000 plus the debit we're paying, in this case, 52.70, 52.80. And then the best case scenario is that we are inside the bear trap and our put credit spreads expire worthless. Our debit spread expires for its max value, which is 50 points or $5,000 for one lot minus the initial 280 or 270 outlay, which will put us right at 57.30 or 57.80. One more thing about this trade. So we talked about how to set this trade up, or at least this is what I look for when I set this trade up. Now, one of the most important things that needs to be looked at and taken care of when the market starts to move. If we are moving inside of the bear trap, it's totally fine, right? We want to capture price somewhere inside of our bear trap, which is between our put debit spread and our put credit spreads. So if the price is slowly grinding towards inside of the bear trap, this is a do nothing time. Okay. It's probably the hardest part of trading, which is do nothing. If the price is starting to aggressively move and potentially, right, it looks like it's going to potentially take out the downside break even. Now, we don't really have anything urgent to do, but we don't want to fall asleep at the wheel. If we break underneath our downside break even, which is, you can see that from today's price, right, we're at 43.75. Our downside break even is about 5% out of the money. If we put this trade on and the market has moved down 5%, this is, the market is moving pretty fast. It's actually moving with more speed than what was pricing in. Something is changing. Maybe the uptrend that we're looking for is starting to, break down. Where's our downside break even? 41.50. Where's 41.50 on the chart? Right. This is close to where we were not too long ago, but maybe we're looking for some potential support here. So you kind of want to relay the chart and have an opinion about what's happening in the market, but by no means you should look at the chart and say, well, this is support. It definitely can't go any lower, because believe me, the minute you say this, the market is going to show you that it most definitely can go much lower than where you think support is. So therefore, we need to have a stop loss for this kind of trade. And the stop loss for me, I look at, what am I looking to make here? Can I potentially make 10% on risk? I think it's a very reasonable target, 10% on risk. What's my risk here? In this specific scenario here, with $5,000 risk plus the debit, which is about 52.70. So that's my risk, 52.70. I'm going to try to make 10% on 52.70. And I'm trying to make about $530 or something. So let's round this off. Maybe I'm going to look to make 10%, which is $500, right? So my target is $500. That's my profit target. Am I going to risk $5,000 trying to make $500 here. I don't think it makes a lot of sense, because if that is the case, one bad trade where you lose $5,000 will take 10 good trades to get back to break even. Doesn't make any sense. So I set my stop. If we move lower and we take out the downside break even, which is at around 41.50, what's my P&L down at 41.50? It's like minus 428. It's probably going to be a little bit more if we start to move down and volatility starts to pick up. So maybe I'm going to risk $600, right? If at any point this trade is down $600, I'm out. Right? So now I'm looking to make about $500. I don't want to lose more than maybe $600, right? So my risk reward is more or less aligned. Now that's starting to sound like a trade plan, right? I know what's my buying power requirement here. I have to put up just over $5,000 for each one of these bear traps. Okay. Put that on. I'm not risking $5,280 in this trade. That's what I have to put up with my broker to put this trade on. What am I willing to risk here? If I'm going to try to make $500, don't want to lose maybe $600-700 if the market is moving really fast. If at any given time this trade is down $600, $650, that's it. It's time to, pull the trade. Market is moving way too fast for this trade. Sure, you could implement certain adjustments and this and that, but you know what? It's probably better to take this trade off, let the market cool a little bit, preserve your capital, both financial and mental, and there's always going to be the next trade. Now, to hit the $500 target, what do I have to go, or where's the market have to go, right? Let's look at, this is just a pricing model, say in 21 days. All right, so this is T plus 21. This is 21 days into the future. If we are somewhere between 43.30, right, at 43.30, I'm up about 550. All the way down to about 4,200. At 4,200, I'm up about $525. So in 21 days, if we're somewhere between 43.30 and 4,200, I should be able to hit my profit target. And then as the time starts to pass, right, the further we go into the future, you see the T plus 0 line is starting to build this hump. I always want to keep an eye on where is my stop now? 21 days into the future, where am I out $500 or $600? 41.24. So in 21 days, my stop is at 41.25. Where's my stop today at minus 500? 41.40. So in about 21 days, my stop goes from 41.40 down to about 41.25. So I have my stop is actually 15 points lower 21 days from now. In any event, we always want to see, all right, where am I out $500-600? That is what I'm willing to risk. That's what I'm willing to lose in this trade. Now, another scenario, and this is the last scenario here, is if the price starts to move higher. Remember, we put this trade on, we're paying a debit of $2.70. If the market runs higher and we do nothing else, we're going to lose $270 or $280. We don't want to do that, right? We're trying to make $500 here. We're going to try to make $500 if the price is going to work with us, and we're going to kind of maybe run up a little bit and then come back down. But anyways, we need to see price revert back towards the bear trap. That's where we're going to hit our profit target. If we end up in a market that just grinds higher, melt up, no pullbacks, maybe we won't hit that $500 profit target, but we definitely don't want to lose the debit that we're paying for it. So what I'm going to do with my go-to adjustment for these kind of trades is what is known as reverse Harvey, right? This is a method that has been around for a long time. Basically, what we are doing is we are rolling our upper long puts. In this example, our upper long option, right? The long leg of our put debit spread is at 43.30. So this is the first upper long, and then we have the lower long, right? We're along the 41.20, except we're long 2 of the puts here and we're long 1 of the puts here. So I'm going to roll the long options. I'm going to roll the 43.30 down, maybe 10 points, maybe 20 points. I don't know. It all depends, where we are in the trade, how much time has run off the clock. But the idea is to roll the upper long down. We're going to collect a net credit for that, which means, let's just assume that we were to roll, let's say we're in this trade, we're in it for about a week or two, and now the price is still outside of the bear trap and it's looking like it's going to continue to move higher, and we need to make an adjustment. So we are going to roll the 43.30 down, let's call it 10 points. Okay. We are going to sell the 40, right? We're long 43.30. So if we were in this trade, we would be selling the 43.30 for, let's call this $46.70. And then we would be buying, our new upper long would be at 43.20. And let's assume that we would be buying it for 44.20. So we're collecting $2.50 on this move. If we were to roll 43.30 down 10 points and collect $2.50, guess what happens to our initial debit? It goes from 280, right? Initially, we put out $280 to put this trade on. And if we made an adjustment by rolling our upper long down 10 points, collecting $2.50, our 280 debit plus 250 credit, our net risk to the upside goes from $2.80 to 30 cents, right? 280 minus 250 is $30 or 30 cents. 30 cents per one contract, or a net total of $30 worth of risk. So by rolling our upper long down and collecting a credit, we're raising our risk graph at expiration line higher. So we're almost break even, which means that if the market continues to run and moves up 1,000 points from here on, instead of losing $280, we're only going to lose $30. Sounds like a pretty good deal to me. And then, God forbid, if the market goes higher, right, we made this adjustment, we took our risk down from 280 down to only about $30. If we get some reversion, we're still eyeing our $500 profit. We just have less risk on the upside. Now, this risk reduction doesn't come with no cost. Of course, there's a cost, right? There's always a positive and a negative. So if we are rolling our upper long from 43.30 down 10 points, right? This is like selling a 10-point wide put credit spread. We sell a 10-point wide put credit spread, collecting $2.50. Our risk, our total risk in this trade, this happens to be on the downside. if we are reducing risk on the upside, we're packing on a little bit more risk on the downside. There's a trade-off. The positive is we're eliminating upside risk. The negative is we're putting on risk on the downside. If you were to sell a 10-point wide put credit spread for $2.50, you're adding $7.50 or $750 worth of risk to the trade. And that risk is going to be packed on the downside. So now our risk goes from 52.80 plus 750. Our risk goes to $6,030 on the downside. We're just shifting risk, right, from upside to downside. If the market is running away and you want to take out some of the upside risk, you're just going to shift risk from upside to downside. It's not going to be in equal amounts. It's going to be the difference between the strikes, right? In this case, we're rolling this put down 10 points. So it's a 10 wide for 250 credit. 10 minus 250 is 750. So we're collecting 250 here, but we're adding 750 worth of risk down here underneath 41.20. And remember, when we sell a put credit spread, this is a net positive delta trade, net positive theta trade, which means that if the market is running higher, and this trade, as you can see, will start to add a little more negative delta to the upside by rolling the upper long or selling a put credit spread, which is the same exact thing here, you will add positive delta to your trade. So you got a chance to fix your T+0 line to the upside. It's going to be insignificant, but it does help you reduce your negative delta on the upside. And it's going to increase your net theta at the same time. So those are positives. What is the negative? The negative is that you're going to take on an additional $750 worth of risk on the downside. And then let's assume that you say, well, I'm already in for, 52.80 worth of risk. Now my risk is going to go, to just over 6,000. I don't want to do that. Well, then what we can do on the downside is we can roll the lower long put. Maybe we'll move just one, or maybe we move both. Instead of moving it up 10 points, we're maybe just going to move up 5 points. This is going to be a small debit. So if we're collecting 250 for rolling the upper long down 10 points, we're collecting $2.50, and to roll 41.20 up to 41.25, we're going to pay a debit, right? The difference between 16.25 and 15.90, we're paying a 35-cent debit. So we have a $2.50 credit minus 35-cent debit. Instead of collecting $2.50 on the upside, we're only collect $2.15, but we're also shifting our risk. We're reducing our risk by $500. So we are going to keep our risk almost the same by rolling the upper longs down and rolling the lower longs up, right? So we're pinching, or we're squeezing in our long legs of this trade. This is going to reduce the size of the bear trap itself. And that's totally fine because, we're not planning on making, $4,500 in this trade. Unless we hold, eyes closed, fingers crossed, holding until expiration, hoping that we're going to end up somewhere in between these two short options, right? We don't plan on making $4,500. We're trying to make $500 here. So by reducing the size of the trap, right, that's the negative. we're shrinking, or we're making this potential reward inside the bear trap smaller, but we're eliminating risk to the upside, and we're also dragging our lower longs down to keep our net or total risk in the trade somewhere close to where we started, which is 52.80 or so. Right. And as long as the price is not punching through our downside break even, we're staying in this trade. So we know that if the price is grinding lower towards the bear trap or the body of this trade, this is a do nothing time, right? Let this work. If the price is running away, we're going to need to start to figure out how to recover our initial debit. The way we do it is by rolling our long legs towards the body of this trade. We rolled the long leg of the put debit spread, and we rolled a long leg of our put credit spread. That's how we take risk out or recover the initial debit. And if the trade starts to really not work with us and the price is really moving against us, and we can see that this is what, based on current implied volatility, which is relatively low. So do keep that in mind. This is what the market is currently pricing in. Here's where we are today, right now, 43.68. This darker gray area is the expected move, right? So we're expected to move, right, up or down just about, I don't know, maybe 3.5%. So if we get to our downside break even, which is 5% out of the money, this means that the market is moving way faster than what the market was pricing in when we took this trade. Something is changing, right? The market is moving with more volatility than the market was pricing in. Something is up. And again, don't try to be a hero unless you're advanced enough to know and you have the tools to keep track of your running P&L. Because if you make one adjustment, two adjustment, three adjustment in this trade, your thinker swims, your tasty trades, they're not going to keep track of your running P&L. You will be lost. You're going to look at losses that are potentially more significant than what your actual loss may be in the trade. It's going to, throw you off. And so unless you are advanced enough, or unless you have the tools to keep track of all of your trades to really know where your true P&L is at any given time, it's just easier to say, look, if I'm down $600 in this trade at any given time, I don't care where the market is. And we know that the only way we can get to that minus 600 number is if the market moves greater than 4% to the downside from the time when we take this trade. If I'm down $600, get out of the trade, let the market cool off. There's always going to be the next trade. It's a lot easier to lose $600 and then potentially have one or two winning trades and put you back ahead than try to implement something you might have heard from someone else and go read something somewhere or watch something on YouTube and you think you understand, and now you're doing things you've never done before in the middle of, market moving against you. If you're down $3,000 in this trade, how many winning trades do you need in order to get to break even? Is that something you want to do? I don't think so. So always easier to say, all right, where is my, get me out point? It's down 600, maybe it's down 700, whatever that number is. I'm down $600 at any given time, I'm out of this trade. Forget about making adjustments. Forget about doing anything else. Forget about what anyone says. Stick to your plan, get out of the trade, regroup. There's always the next trade to take. If the market is running higher, figure out a way to recover your initial debit. Maybe you recover all of $280 and you end up with no profit. And that's okay, right? It happens. The only time the only thing you spend really is your time. And if we are in a mean reverting type market where we go up a little, we go down a little, we go up a little, we go down, but overall we end up somewhere around what the market is currently pricing in, right? The market is pricing in a move down to about 42.16. Maybe we wouldn't move as much. Maybe we only move down to about 4,300 over the next, I don't know, 30 days. At 4,300 in 30 days, you will more than exceed your profit target, right? Based on this pricing model, at 4,300, 30 days from now, your unrealized P&L should be somewhere around 1190, which is just a little greater than 2x your profit target. All right, so that's how I look at this trade. That's how I set this trade up. What else? If you have any questions, you can ask. We're going to go on for, I don't know, maybe another 15 minutes. And maybe we should try to put this trade on. So what I'm going to do, there's a question from Jose. Do you use Option Explorer to execute and keep track of position adjustments or tracking with a spreadsheet? So I do not keep a spreadsheet. I replaced my spreadsheet with Option Explorer. I don't know if Option Explorer has the capability of sending orders to your broker. If it does, I wouldn't use it. I don't use it. What I do here is I draw up the trade. I plan my trades. I plan my adjustments. It does keep track of all of your adjustments, right? Because when I enter the trade and I commit trade, right, it's going to take this trade and it's going to group all the options that are part of this trade. If I make a change or if I make an adjustment to this trade, it's also going to keep log of this same trade. If options I'm closing, it's going to keep track of my running P&L. If I took a loss somewhere, it'll account for it. If I took a profit somewhere, it'll account for it. At any given time, I know what my P&L looks like, and I can make potential adjustments looking at the trade and having the real values or real P&L. Because a lot of times, if you don't keep accurate trade adjustments with all the prices, you may think you're ahead, but you're already maybe past your stop loss. So now you're just digging yourself deeper and deeper into trouble that you should have avoided had you known what your real P&L looked like. JB is asking, are you choosing strikes based on deltas? For example, buying a 40 delta put, selling a 25 delta put, then selling 2 10 delta puts or whatever. You can. But the way I look at it is I know that I'm buying a 50-point wide put debit spread and I want to pay, right? This is a put debit spread. I am trying to pay. I'm trying to pay somewhere around, I don't know, $10 for it. Could be 11, could be 10. It doesn't make a difference, right? It's not 30 and it's not 5. It's somewhere around 11 or 10. 1050, 1070, it all works. So I go out and I find a 50 wide for around 10. I don't care what the delta is. It could be delta 40, it could be delta 35. I don't look at deltas like that, but they're all going to work out. If you wanted to, test this out, go and look at, if you can go in, what's that called in Thinkorswim, where you can back test. You can go back and choose a time when the VIX was at 20 or higher and look for how far out of the money and where is a 50-point wide put debit spread that's trading for around 10, and look at what the short leg delta is, and it's going to be about the same toss on demand. That's right. And if you look at 50 wide for 10 when VIX is at 20, and then you compare 50 wide for 10 when VIX is at 13, I think the deltas are going to be very close. The two put spreads are going to be, way different in percentages out of the money. When the VIX is at 20, that put spread could be 7% out of the money. Right now, VIX is kind of low. Volatility is low. So a 50 wide for 10 is only about 1.5% out of the money. The deltas are going to be about the same. So I look at the price, the total price, or total debit for that spread. You can look at deltas, whatever works for you. But I think it's just easier to go out and look for 50 wide for 10. I buy one of those, and then I go out and I look for 250 wide put credit spreads for a total credit of 10. So I spend 10 on the debit spread. I collect 10 from the credit spreads. That gives me a net break even, or net even as far as my price that I am paying to put the trade on. One more thing I want to touch on is position sizing. As far as position sizing goes, so in this example that we looked at just now, we have a debit to enter. Debit is 270. The broker is going to ask for $5,270 to put this trade on. And we know that our max allowable loss, this is our stop loss in our minds. I wouldn't use any GTC to close. It doesn't really work, because if you make an adjustment, now you need to change your GTCs and it just gets crazy. You know that at any given time, if you're out, whatever that number is, if it's $600 per one lot, that's your exit. Let's just assume that, I'm going to make some numbers up. Let's assume that you have a rule that you're not going to risk more than, I don't know, $2,000 for any one given trade. And that $2,000 represents some percentage of your overall account. Okay. $2,000, that's your total loss that you will be willing to accept on any given trade. You take 2,000 and you divide 2,000 by, say, $600. If you're thinking that, for one lot, if this trade is down $600, that's your exit. So you're going to risk $600 for one contract in this trade, and you're not willing to accept more than $2,000 worth of a loss. So you divide 2,000 by 600, and you get 3.33333, right? So we cannot do 3.33333 contracts. So we're going to round this off to 3. So 3 contracts. If you put this trade on, 3 contracts, and it's working, it's whatever. At any given time, if you're down $600 per contract times 3, if you're down $1,800, is that within your max allowable loss total for any given trade? If your max allowable loss for any given trade is $2,000, if you take this trade, 3 contracts, each contract is down $600, you have 3 contracts, you're down $1,800. Is that within your allowable loss limit? It is, right? You're willing to lose, or you're willing to risk $2,000 in total. You take 3 contracts. You max potential loss here If everything goes wrong, you're out $1,800 if you lose $600 for every one contract. So that's how I would size this trade, right? You also kind of want to pay attention to your buying power requirements. So for this trade, let's assume 52.80 is for one contract. You do 3 contracts. So your margin for this trade in a 3 lot is going to be just shy of $16,000. If you have a $16,000 account, and this is going to take up 100% of your available cash, then I think that 3 contracts is way too much for you. Like, you don't want to have, more than a third of your overall account tied up in any one trade, even though you're not risking that $5,280. But you don't want to have, you want to have some dry powder, because you definitely don't know if you may need some additional cash to, make adjustments that may be net debits, and it'll require additional capital to make those adjustments. So you always want to, keep some buying power available, even though we're not dealing with naked options. So keeping 50% buying power is really not relevant here, but you want to have some dry powder just in case you need to make an adjustment and you need to add $1,000 worth of risk to this trade. Right. So you also not only want to look at total allowable loss for the entire trade, you also want to look at how much of your overall account is this one trade going to take up. And if it's more than 50%, don't deal with it. I'd say 30%, but that number, you could do whatever is right for you. But, I wouldn't want to have more than 30% of overall account tied up in this trade, because you know what? You put this trade on 44 days DTE, right? Maybe 25 days later, this trade still has 20 days to go. And whatever the market is, maybe you want to put another trade on, right? And if you used up all of your capital in this one trade and you have to sit for another 20 days waiting to potentially, until you hit your stop loss or your profit target before you put next trade on, I would probably do less number of contracts, trade smaller, and maybe have 2 trades going, right? One trade, you started off at 44 DTE, 20 days runs off the clock. You still have about 24 days to go in this trade, and you start to plan your next trade. And maybe you hit your profit target in the first one, with maybe 18 days to go. You take it off. You took one off. You already have the next trade going. So now you wait for, kind of 50% of the DTE's mark, right? You put the trade on at 45 DTE, maybe at around 25, 21 DTE, you start to look for the next possible entry. So just kind of have 2 trades in rotation. So instead of having one concentrated position, I would probably go smaller in each of the trades and have 2 trades going at the same time. Question from Jose. Option Explorer also does on demand. It's not on demand, but they have the data for you to go back to as far as like 2005, maybe. And this is way before they had the weekly options. So it's not, as much data as you would have in the recent years. But yes, you can go back, way back, in like 5-minute intraday increments and look at different adjustments, and you can play out different scenarios to see how your outcomes would change. Shameless plug for this Option Explorer. I am not the owner of this platform, but I have been using it for probably just over 10 years. And it did make a big difference in my trading. It really makes you look at things different, and how you understand and visualize risk. Highly recommend. It's not cheap, but I think it's definitely worth it. The way I look at it and the way I justify paying for it is that the amount of money I potentially saved from not making stupid mistakes when it comes to adjustments or staying in the trade for way too long because I don't know what my true P&L today looks like. I probably saved, I don't know, 100x of what I spent on it in the last 10 years. So to me, it's worth it. And it all depends on, how much trading you do and what kind of adjustments you make. If you're just, sell a credit spread and, exit at, 4x credit, and that's as far as your trading goes, maybe you don't need Option Explorer. You're better off with a spreadsheet. But if you're going to do multi-leg option strategies that require several adjustments where it's, a little easier than keeping a very long spreadsheet, I highly recommend considering picking up Option Explorer, because I think in the long run, it can help you become a better risk manager. For those that are still up and not asleep, let me know if you have any questions. If not, it's almost that time. I certainly hope, we did talk about a lot, and I'm pretty sure it's not as clear as I wish it was. So we could continue to talk about it. You always have an opportunity to ask questions in the chat. You could also, if it's something specific on Discord, we have a channel. It's a 112 bear trap. And I think this trade qualifies as a bear trap, even though it's not a 112. So if you want to talk about this specific trade and not clog up the main chat room, feel free to post in the 112 bear trap channel. I will be more than happy to answer any of the questions and help you guys take this trade and possibly make adjustments to the trade setup to make it work for your overall trading plan. Josh is saying, would you mind giving the strikes you would choose to do this trade on a smaller level using SPY or XSP? I'd like to enter it and see how it would work on my platform. So the trade that we looked at today, this is SPX, and XSP and SPY is this. It should be very similar, if not the exact same strikes, except that you just want to get rid of the last digit. So here we have, we are long 43.30, 42.80. On XSP, it's 433, 428. And same thing for SPY. Just get rid of the last digit. XSP options have the same exact tax treatment as SPX options. Liquidity is decent. Pricing gets a little weird after market close. The bid ask just gets, you can see like some options have zero bid. And if you have a zero bid and a $5 ask, that makes your options mid price $2.50. And if you short an option at 90 cents and now the mid is at 250, you are staring at about a $1.40 loss, which is really not a loss. It's only showing that because the mid price of the option that's currently, quoted as 0 by 5 is really not the true price. So it gets a little weird and your P&L could look retarded a little bit. So that's something that you want to keep in mind, but liquidity is fine. The size is only 1/10, which is great. The goal is to do it, do a 1 lot, do a 2 lot. Even though if the profit is like really insignificant, that's fine, but you just kind of want to, learn how to set up the trade, how to put the trade on, how to, make adjustments when you need to. And then when you know the trade inside and out, you could either scale up, right, increase the number of contracts, or you could, instead of doing 10 XSPs, you can do 1 SPX. And then, right, so you're always working on that same exact trade, instead of saying, all right, I got this, I've mastered it, let me go find something else to trade. That's not the right thing. If you got this, if you feel like, all right, you know exactly what's happening, you know how to handle a trade, don't go out looking for something else. Just, scale up your business and increase number of contracts and so on and so forth. Oh, sorry, Josh. And then, so buying 433, selling 428. That's the put debit spread, and then selling to open 2 of the 417, 412. And the market is closed, but the mid right now is 240. It was 280 a little bit earlier. All right. We're going to stop here. We could come back and talk about this more. If you have any questions, you can ask anytime. We'd love to help you out. Other than that, enjoy the rest of your day, and I will see you all tomorrow.